baby, we're in the midst of one of the most exciting Canadian bank earnings seasons I've seen in a very long time. I mean, we saw Bank of Nova Scotia post today going to the frigging moon, and BMO, in contrast, is tanking miserably as we answer the questions every Canadian wants to know. Are these banks collapsing? How does the average consumer look on their delinquencies with credit cards, their mortgage debt? We're going to break all of that down as we take a look at some major banks posting later this week. Royal Bank's going to post, Toronto Dominion Bank, so much to look forward to. So if that is a conversation you'd appreciate, damn it, go down, hit that like button, and let me know if you're buying these banks. So before we look at the earnings, it's important to see how the broader sector is doing, and it's basically nullified today. BMO is basically nullifying Bank of Nova Scotia's gains, and same with the rest of the sector. There's just not a whole lot going on. So if you own things like H Bank, the Horizons Equal Weight Bank ETF, sorry, but you're not seeing a whole lot of capital gains. Same with the BMO Equal Weight Bank Index here, but these things are still good buying opportunities. Like Pokemon cards, I'm always going to say you got to collect them all because the performance of the dividend growth is what you're chasing when you're buying these banks. And I personally believe there's still some upside ahead of us here, and I'm going to break down why. So Bank of Nova Scotia is finally catching up. The kid that was beaten down in the group the most, that didn't see the recovery as quick, is now up 20%, which is more in line with all the other banks from the October lows of last year. And congrats to anybody that picked up the over 7.5% dividend. You're up probably anywhere from 15 to 20% if you bought the low. You locked in a huge damn dividend yield that they did increase on that last earnings report, right? So if we get into this, the thing everybody wants to know is how are the delinquencies in the 90-day past due loans look? And honestly, they're not that bad. We're nowhere near the pandemic levels. We're still on the incline, but it's starting to nominalize a bit. So this was probably the worst quarter over quarter look for mortgages, specifically going from 0.16% to 0.2%. Ouch, that's kind of painful, but nothing too crazy. I think if we get into the half percentage points, like if this were to double again, I would be much more concerned. When it comes to personal loans, it's actually declining from 0.69% to 0.55%. Credit cards from 0.7 to 0.79, which I think represents more of the end user, the consumer, because everybody has credit cards. Most people probably don't have mortgages. So credit cards, not the best thing. It shows the consumer is continuing to struggle a bit. This is an all-time high for the credit card 90-day past due loans. You take it all into consideration, though, from 0.25% to 0.26%. It's not that bad, right? But the problem is it's on this trajectory to the upside that continues, and we don't want to be seeing this for the next couple years. I mean, eventually this is going to have to nominalize or we're going to be in a much worse market environment, but I really don't think that's going to come. I think for right now, we're just still dealing with the higher interest rates. When they start to cut, that's when things will stabilize a bit. You can see the loans and the delinquencies inclining here, but if you take a look at residential mortgages specifically, we can see about 33% are variable. These are the people that are praying to God the interest rates come sooner rather than later. I am on the fixed side of this $288 billion portfolio of mortgages. 67% fixed is great, but as these renewals come into play, it'll be neat to see how those credit ratings come into play because loan losses and loan loss provisions are based off the quality of the debt. So let's say you were making $200,000 a year and you bought $1 million mortgage, and now that mortgage is going into renewal from 2% to say 5 or 6%. Well, all of a sudden that income doesn't look as great against the mortgage payments. So the bank has to lower the rating of the quality of that debt, which means because there's risk of it defaulting, they have to put higher cash positions aside to deal with it, right? So that's kind of the big concern and why loan losses persist. You can take a look at the total portfolio here. 74% is uninsured, which is great because that means that people put a higher than a 20% deposit down, meaning you didn't need to take the insurance. So the 26% is likely the mortgages outstanding that have the highest risk of issue on renewal. But if we take a look, because the higher interest rate environment allows banks to make more money, we can see they're making record interest income. That's great. And we can also see non-interest income continues to grow for them. So that gives them a total record revenue of $8.43 billion versus $8.27 billion just this time last quarter. Now, leading into the provision for credit losses, because they've been stabilizing a bit, we're seeing about $962 million versus $1.25 billion this time last quarter, leading to higher net income. Their total net income here equaled about 2.2 billion, which equal to about $1.70 per share, which is what is leading to this 3-4% bump in Bank of Nova Scotia today. So it's nice. And this is going to continue to be very impressive because as things stabilize, it's likely we'll get more dividend increases. And if you bought this company, 10 years ago, you have barely seen any capital growth. But again, it comes to cost averaging. If you are a newer investor, you're looking for discounts in the market, you want to buy these dips, right? You want to pick the opportunity up when it kind of presents itself, and I've been telling you to be buying these banks. I haven't been personally picking them up too much because I've been more fixated on US tech companies, as many of you know, but my fiance, she has great exposure to these banks, and I'm still likely going to pick some up this week, especially these equal weight bank ETFs. But in contrast, Bank of Montreal is kind of getting devastated here and is continuing to go down in the midday. And it's one of those stocks that did recover pretty early on from the October lows. I mean, it jumped up 25% and is now starting to retrace a bit because these earnings weren't great. You take a look at their provisions for credit losses, and their impaired loans have increased literally quarter over quarter, now sitting at 473 million versus 243 million in Q2 of 2023. Basically over doubling up from Q1 of 2023. If we take a look and how this breaks down, 27% are real estate mortgages, 14% are consumer and personal, and then 2% are credit cards. But what was interesting is oil used to be one of the largest exposures for Bank of Montreal, and now only makes up 1% of their total, mortgages outstanding. So nothing too crazy, fairly diversified mortgage set, but it is not helping them at all. Because if you take a look at their interest income, that is actually declining, which is a bit of a surprise over last quarter. Year over year, it's increased by about 700 million, which is great to see. But total revenue has actually declined from from 8.3 billion to 7.6 billion. So we're going down, but still up from Q1 of 2023. All in all, net income 1.29 billion versus 1.7, leading to $1.73. And just because of these higher provisions for credit losses sitting at 627 million, which continues to go up pretty dramatically quarter over quarter, that's what's concerning a lot of people and leading to the underperformance of the stock. But we got a lot of earnings coming out, and I feel like we're going to get a mixed bag to continue here. If TD can just recover, I think we'd be in a good place, because this is one of the second largest company in Canada, and it's posting on February 29. And if we just take a look at TD stock, it has been the hardest hit of the bank so far in the recovery, just because of all the bad news going on. I don't have to reiterate, First Horizon, I think they had a deal in the US with one of the regional banks that didn't go through, and they've just been continually getting hit from government, saying that they've been doing nefarious things. So their stock is still down 24%, which I still think is going to be a fairly healthy buying opportunity depending on what this quarter looks like. Royal Bank was another one of the quickest to recover out of the last October lows and is still holding up 20%. This one's going to be posting tomorrow, so something to look forward to. Canadian Imperial Bank, another really interesting one with a whopping 5.8% dividend, and the best recovered stock, up 38% from those lows. But again, we're kind of back to a nominal place with these companies. So we really need to see a recovery in the markets before these banks are going to go back to any crazy highs, I think. So the real buying opportunity is kind of starting to pass us here. But I really think if you want a really healthy, stabilized income, and you look at something like the BMO Equal Weight Bank Index here, this really kind of took out the volatility of the individual banks and has also recovered by about 15 to 20% since the October lows. And again, if you look at the long run of this, it's probably one of the best things that you can buy to kind of collect all these Pokemon cards, as I like to say. You really want to collect them all, because combined, you get really great market growth from the capital gain standpoint. But from 10 years ago, you went from 6 cents, a share to a whopping 14 cents today. So over doubling of the dividend. So if you could lock in a 5% yield a decade ago, you're now sitting at a 10% yield on cost. And from a decade ago, which surprisingly is now 2014, right? Your stock is still up 64%. Obviously, we're not talking about the highs of the pandemic, but still your rate of return has just been absolutely wonderful. But I'd love to know what you think about these banks in that comment section below, and if you're buying them, and consider subscribing for when we break down these other banks that are posting in the coming days.